Michael Burry just bet all in on a global economic collapse. The whole world is facing so many challenges nowadays, either on the Eurasia border or in the South China Sea. Not only this, but these are all things that are affecting the whole global economic collapse. Currently, the world is going through turmoil and a recession's looming. Investors are afraid of what will happen to their money. But there is one person, the housing master before the financial crisis. The step taken by Michael Burry shocked most investors. Everyone is wondering, what is he doing next? He had even given a statement that horrified investors. Is the industry really going to collapse currently? And if yes, then what's the option to do right now? Hello everyone, and welcome back to Finance Basics, where in this video, we are going to find out the answers to all of these questions. And we'll find out what Michael Burry has to say about the global economic collapse. Investing is one of the biggest ways to earn money, and having knowledge of the market will always help you to find out the best choice. So let us get a detailed idea about Michael Burry's bet all in on the global economic collapse. Hedge fund manager Michael Burry, who was celebrated in the film The Big Short for his bold bet against the housing market just before the Great Recession, is back to sounding the alarm online. This time, Burry sounded the alarm about a two-stage cycle. First, a reduction in multiples, and then a reduction in earnings. Should investors be concerned? Before we get into this video and discuss what's going on, let us understand who Michael Burry is and what is his career record. Burry is well known in the investment market. He established his own investment firm. He was already well known in the investment community because of his track record of success in value investing, which discussed on Silicon Investor message boards starting in 1996. As a result of his stock-picking performance, he received attention from major institutions and investors like Vanguard and White Mountains Insurance Group, and celebrities like Joel Greenblatt. Value, in Burry's view, is something that should be approached in a purely conventional manner. He has been quoted as saying, "All my stock choosing is 100% based on the notion of a margin of safety." This is a key tenet of Benjamin Graham and David Dodd's 1934 book, Security Analysis, which he credits with shaping his investment approach. Burry closed his website in November 2000 and used his inheritance and family loans to launch the hedge fund Scion Capital. He chose to honor one of his favorite books, The Scions of Shannara, from 1990 by Terry Brooks. He made his investors astronomical returns very rapidly. According to author Michael Lewis, in his first full year, 2001, the S&P 500 plummeted 11.88%. Sales for Scion increased by a whopping 55%. When the S&P 500 dropped by 22.1% the next year, Scion rose by 16.1%. The following year, 2003, the stock market finally came around and increased 28.69%, but Burry topped it again with gains of 50%. He was handling $600 million and turning away investors by the end of 2004. Burry was able to accomplish these profits partially by shorting expensive tech firms during the top of the internet boom. Burry began concentrating on the subprime sector in 2005. He accurately forecasted that the real estate bubble will burst in 2007 by analyzing mortgage lending procedures in 2003 and 2004. Based on his analysis of residential property values, he predicted that the value of subprime mortgages, particularly those with teaser rates and bonds backed by these mortgages, would begin to decline when the initial rates were replaced by much higher rates, sometimes as soon as 2 years after origination. Based on this assessment, he decided to short the market by purchasing credit default swaps from investment companies like Goldman Sachs and others to hedge against potentially risky subprime loans. Investors in Burry's fund sought their money back because of fear that he had made erroneous projections about the value of credit default swaps, leading to a mutiny. By the end of the day, Burry's predictions were spot on, and he ended up making almost $700 million for himself and the rest of his investors. Between its launch on November 1st, 2000, and its end in June of 2008, Scion Capital earned returns of 489.34%. That's the net of fees and expenditures. Burry, according to his website, had all his short credit default swap bets liquidated by April 2008. Therefore, he missed out on the bailouts in 2008 and 2009. He eventually decided to concentrate on his own investments, and therefore he dissolved the business. Burry wrote an opinion piece for the New York Times on April 3, 2010, in which he suggested that anybody who had paid close attention to the financial markets in 2003, 2004, and 2005 would have been able to see the developing danger in the subprime markets. He criticized federal authorities for ignoring advice from others outside their inner group. Burry relaunched his hedge fund in 2013 under the name Scion Asset Management and began filing reports with the SEC as an exempt reporting advisor in the state of California. Investments in water systems, precious metals, and agricultural land have been his primary emphasis. According to what he's reported, no one should take access to clean water for granted, but it's not that simple. Water is a contentious and politically charged legal issue. SEC Form 13Fs, submitted between the fourth quarter of 2015 and the third quarter of 2016, provided investors with a glimpse into Scion's portfolio, since such filings are required when a fund's assets exceed $100 million. More than 2 years later, on February 14, 2019, Scion Asset Management filed a 13F revealing that Burry had a wide variety of large-cap equities and a total of $103,528,000, slightly beyond the reporting level. In an email reported by Bloomberg News in August of this year, Burry said that passive investing's rise in popularity has orphaned smaller value-type assets abroad, leading to a bubble in major U.S. business equities. Alphabet Inc. at $121 million and Facebook at $24.4 million were the fund's two biggest investments that year. According to a recently deleted tweet, Burry opened short positions on Tesla around early December 2020 and presumably expanded to his short bets once Tesla's market value reached that of Facebook. Burry said that my previous big short became larger and bigger and mocked Tesla bulls by telling them to enjoy it while it lasts, while discussing the eventual fall of Tesla shares. It was revealed in May of 2021 that he had placed options on more than 800,000 Tesla shares. After Tesla's stock increased by 100% in value and by October 2021, he publicly admitted he was no longer shorting it. He disclosed roughly $31 million in puts on ARK Invest ARK Innovation Index ETF during the second quarter of 2021. Michael Burry reported in a recently deleted tweet that the S&P 500 index lost between 25 and 26% in the first half, while the technology-focused NASDAQ fell between 34 and 35%. To add insult to injury, the cryptocurrency market cap plummeted by almost two-thirds. Burry, as the founder of Scion Capital Management, issued a warning that the deterioration pointed to the presence of several compression mechanisms. But Burry thinks the whole market slump is just maybe halfway over. He predicts that earnings contraction will soon follow, which will pique the interest of investors on Wall Street. Multiple compression is easiest to grasp if you have a firm grasp on the two main drivers of stock price appreciation. For starters, the market is anticipating a boost in underlying profits. The second reason is the rise in market multiples, which is the premium paid to buy a future stream of profits. Multiple compressions may seem scary, but it really just depicts the normal ups and downs of the free market. During certain periods, investors are ready to pay a premium for particular assets, and in others, they expect a discount. The market reaches a steady state of equilibrium, at which point it begins the cycle anew. In contrast, the compression cycle is what Burry is most worried about. Investors' reluctance to continue paying what was formerly considered reasonable premiums has contributed to the current period of market volatility. However, underlying weaknesses may constitute the basis of the next slump. That is to say, profit compression counteracts the primary cause of stock price fluctuations. Potentially, investors are abandoning the market because they have lost faith in the firm's ability to increase its profits in the future. If that happens, it would be the second stage of the bear market, when investors stop believing that American businesses can weather the storm. Let us know in the comment box what all you think about it. Subscribe to our channel to watch more videos like this one. And thanks for watching.